Welcome back, everybody, to video number 2 in Chapter 2. And when we left off, we were looking here at ownership structures between proprietorships and partnerships, as well as corporations. There's some slight differences in that partnerships and proprietorships are smaller companies, have our permanent capital accounts, and the owners withdraw their money using a drawings account. Whereas in a corporation, we have retained earnings where we have revenues and expenses, and dividends is where our owners, the stockholders, uh, subtract their earnings as well as uh, um, our common stock are in the uh, equity or real accounts. Okay, so let's look at the accounting cycle. There are 9 steps in the accounting cycle. The 10th one I often include are reversing entries. But here, this is important, so be sure you remember this from 101. We're going to look at the business transaction, journalize it into a journal entry, post it to the general ledger. From all those transactions, we will prepare an unadjusted trial balance. After making our adjusting entries, we will prepare an adjusted trial balance, and from those we will prepare the financial statements from the adjusted trial balance. Some people get confused in that the closing entries are done after the financial statements, because if we did the closing entries before, we would have zeroed out the income statement and we wouldn't have anything to report. In any event, the 8th step there is we do the closing entries and post them to the general ledger. And then the final step is we post a post-closing trial balance just to make sure that 1, all the debits equal the credits, and 2, we do not have any nominal or temporary account showing. Okay, let's take a look at a example here. Speedy Delivery, incorporated on July 1, 2025. During the first month of its operations, important because our statement of retained earnings will start with 0 as beginning retained earnings, they invest $10,000 in cash for common stock, pay some rent, purchase some office equipment for $3,000, purchase delivery, etc., etc. And they want you to prepare a summary of these on the accounting equation. So if we look at that, we have this lovely diagram here where we have done all those journal entries and how it hits the accounting equation. The one piece that might be a little, what do I want to say, a little bit confusing is expenses. Here, we have debited or increased our rent expense and credited cash as our journal entry. But when it comes over that increase to that expense, when it comes over here to the stockholders' equity section, you'll notice here that it is a subtraction from stockholders' equity. So it's a little confusing in that we increase rent expense for the income statement, but decrease retained earnings when it comes over in our closing entries. The rest of this should be pretty familiar to you from the standpoint of debits and credits, but I'll run through it real quickly. In the first example, we've increased cash, we've debited cash and credited common stock for issuing that stock. Rent expense, we've debited rent expense and credited cash. For purchasing equipment, we did that on account, so we have debited equipment to increase a left-hand side account and credited accounts payable. Then on number 4 here, our service revenue, we're going to increase revenue on our balance sheet or on our income statement with a credit, but we've also debited cash for $1,500. So debit cash, credit revenue. And then in number 5 here, we've borrowed some money here. Whenever we borrow money from the bank, you can bet it's going to be a note payable. The banks are very fussy about their paperwork. And we're going to debit cash because we received that cash, but we've also incurred a liability, notes payable. Service revenue here, we have performed some service, but we did it on account, not for cash, sometimes called on credit. So here we've debited accounts receivable and credited revenue. And lastly, we've had 3 expenses here: salaries and wages expense, utilities expense, and advertising expense. We're going to debit all of those and credit cash to pay for them. Again, when we increase those expenses, when they come over to retained earnings, they will be a subtraction to get to net income. So revenue minus expenses are net income. And then eventually, we didn't have any dividends in this problem, but you can see that the accounting equation has remained in balance. Okay, let's take a look at how we record and summarize accounting transactions. So, what to record? The FASB, you'll remember that's the Financial Accounting Standards Board, and it uses the phrase transactions and other events and circumstances that affect a business enterprise. Pretty academic. And we have external events. That's between an entity, the company, and its environment, usually suppliers or creditors or whatever. But also sometimes we have internal events. That would be an event that occurs entirely within an entity or company. All right, so let's look at that. We purchase a computer. We've discussed guided trip options with a potential customer. We've paid some rent. So those are all going to be, yes, we are going to record purchasing a computer, but we're not going to discuss, or I should say record, a guided trip discussion because we haven't had any exchange of money or it's not a transaction. And then, of course, if we pay rent, we are going to record that as well. So how do we do that? We do that, of course, with a journal entry. We call that journalizing. And we have our general ledger. That's going to contain all our asset, liability, stockholders' equity, revenue, and expense accounts. Our general ledger, a general journal, is a chronological record of those transactions. So each time we make a journal entry, we record the time and a description, and we attach the documentation behind that and put it in a file so we can extract the little beauty should our auditors or we want to look at it. Okay, let's look at one. Here, a company's stockholders invested $15,000 cash in the corporation in exchange for shares of common stock. On the same day, the company purchased computer equipment for $7,000 cash. So here you can see our general journal, and on September 1, our cash went up, our common stock went up, so we debited cash, $15,000, and common stock being a right-hand side account, we credited it to increase it. You can see a couple of things that are a little subtle here. One is this J1. That's the general journal page number. So we want to be able to get back to this transaction if the auditors or ourselves want to find that in the future. Also, we have a posting reference here. That posting reference is not included in this particular illustration, but that would be the general ledger account number here. So then when we purchased equipment, we're going to debit equipment and credit cash for that. Pretty straightforward. Okay, the general ledger. The ledger provides the balance of each of the accounts, and it keeps track of the changes in those balances. Pretty straightforward there. That general ledger contains all the asset, liabilities, stockholders' equity, everything, revenues and expense accounts. And you can see them here, all listed. These are the key ones, and you'll remember them all, hopefully, from your 101 course. A chart of accounts lists all the accounts and their account numbers that identify their location in the ledger. And the numbering system usually starts with the balance sheet and follows with the income statement accounts. And this is a perfect illustration of how that's done here. You can see that all the asset accounts have a 100 series here, and the liabilities have a 200 series. The stockholders' equity have a 300 series. Revenue has a 400 series. Oftentimes, expenses will have a 600 series. It isn't that way on this illustration, but normally the 500 series would be associated with costs, like cost of goods sold. And away we go. Now, when we do a listing of our trial balance, it's going to be listed in general ledger account number order. Okay, the following illustrations are going to show the basic steps in that recording process. And we're going to use October transactions of Pioneer Advertising. The period that Pioneer uses is monthly. That isn't always the case in corporations, but for this course, I think most of the examples are monthly. A basic analysis and debit and credit analysis precede, of course, the journalizing and posting of each transaction. Then we use a T account to illustrate how that looks in standard account form. So let's take a look. Here we've gone through the process, and I don't think this is terribly difficult. Here we have invested $100,000 in cash in an advertising company. And so cash goes up, common stock goes up. Okay. Then down here, it shows how that ripples through the general journal, the journal entry in this case. In this case, you see the posting reference is, in fact, the general ledger account number. And then in the general ledger, we're going to find a cash account and a common stock account. Usually that's going to have a running balance for each of those general ledger accounts. Okay. So now here we've done another analysis. We've purchased some office equipment costing $50,000. And equipment goes up, notes payable goes up, and then the effect on the general ledger. Receipt of cash for future services. Here are cash. We've received cash in advance, so this is going to be unearned service revenue. That's a liability, even though it has revenue in its name here. If you see, if I can find my cursor, there it is. Even though it has revenue in its name, it is a liability because it's unearned. We only show earned revenue in our income statement, and then the effect on the general ledger. Now here we've shown the payment of monthly rent. That's pretty clear cut. Here we've shown the payment for insurance. That's going to go into a prepaid insurance account, as you'll recall from your 101. And then we purchased some supplies on credit. And finally, we signed a contract. Now, in this case, we don't have a journal entry. So this looks like a good place for us to stop this video. And when we return, we will continue in Chapter 2. Until then, bye for now.